The economy in Miami has been growing rapidly over the last couple of years. Huge migration, big businesses moving to the area, or the really nice weather. All these things have combined to make Miami one of the hottest rental and housing markets in the entire country. But with all that growth, you start to wonder, is there a limit? Because according to Realty Hot, Miami has now become the least affordable city in the entire United States. Is this growth sustainable? And is Miami a good place for real estate investors to consider investing? Today, we're going to dive into the data and learn all about the Miami housing and rental markets. I wanted to do the Miami data today because so much is being made about their economy. And if you haven't heard about it, Miami was the second fastest growing metro area in the US since 2019. You know, Miami, Florida has always been a relatively popular place to live, but it seems that starting at the beginning of the pandemic, Florida just became this destination and people were moving there in droves. In fact, Florida as a whole grew 24%. They had 24% net migration increase since 2019, which is absolutely enormous. And obviously that has really big implications for the housing market when there's this massive influx of people. Miami in particular has been getting attention because a lot of big businesses seem to be moving to the area. Back on July 9th, 2022, the Wall Street Journal ran a story titled "Miami's Gold Rush, Finance Firms and Crypto Move In." We've seen huge companies, like one of the biggest hedge funds in the whole country called Citadel, move from Chicago to Miami. We also saw Elliott Management, another big hedge fund, move to the area. Blockchain.com moved to the area. So a lot of people have been calling Miami and the surrounding areas Wall Street South because a lot of finance firms have been moving from the New York Northeast area down to Miami. Of course, one of those firms was FTX. The Miami Heat Arena was named FTX Arena for just a little while until that whole thing fell apart. But generally speaking, a lot of finance firms have moved to the area. There is, of course, some downside to all of this migration, and that is mostly in affordability. According to a real estate data firm called Realty Hot, Miami is now the least affordable city in the United States. We've also seen rent surge. We'll talk about this in detail in just a minute. I think it has gone up 50% over the last couple of years. So this has put a lot of financial burden on the people who live there. And it makes you wonder if the housing market is sustainable. It makes you wonder, is this market going to crash? Is it going to keep growing? So I'm going to turn over to our data now, and we'll get into exactly what is going on in the Miami area. All right, so we're going to start here with our median sales price, which is, of course, what everyone wants to know. And what you can see here is that unlike the rest of the housing market, the Miami market has not seen declines in the median sale price in the US. So it has fluctuated a little bit over the last couple months, and that's pretty normal given seasonality. But you can see that as of the last couple of months, it's actually up relatively flat. Unlike the rest of the country, which is seeing 2 to 3% declines on average. Obviously, some cities like Austin, which we talked about recently, Seattle, San Francisco have seen bigger declines. On average, the decline right now is about 2 or 3%. Miami does not fall into that category. As you can see, Miami's prices are still relatively high and haven't really come off their pandemic highs. Now, the main reason for that, if you come down here, you can see this is all homes for sale. This is basically just the total inventory on the market in Miami, which is how many houses are for sale at any given time. And as you can see, it is extremely, extremely low here. Normally, before the pandemic, we were seeing an average inventory in Miami at about 18,000. Now, and then it just basically fell off a cliff. Now we're down at about 12,000. So that's about 50% lower of where it used to be. Now, it's definitely come back off of its pandemic lows, but it is really flattened out. And in a market that is going to decline precipitously or quote unquote crash, you would expect inventory to go up a lot, right? Because not a lot of people are buying, but people are still trying to sell their houses. That leads to higher inventory, but that has clearly not happened here. In fact, inventory is really flattened out for about the last 8 or 9 months, and the most recent reading that we have for February is down. Inventory is really helpful because it helps measure the balance between supply and demand. It is pretty imbalanced right now because it is staying relatively flat. And so that is, to me, the number one reason why prices haven't come down in Miami just yet. Now, if you want to understand what is going to happen in the future, you can look at some lead indicators. Of course, no one knows what's going to happen, but I just want to show you one of the dynamics that I think is really important and relevant to the discussion about Miami real estate is new listings, right? So this is a measurement of how many people are listing their homes for sale. And as you can see, again, we were expecting, 4K per month here. Pre-pandemic, it was relatively stable, but it's come down here and is staying really low. It's not crazy low. It's like 4,000 down to about, 3,200, something like that. But that's still 20% down from where you would expect it to be. And that, to me, indicates that inventory is unlikely to rise. And again, like I just said, you would expect in a market that's going to decline for inventory to rise. And so because new listings are down so much, that is unlikely, at least in the short term. Obviously, we don't know what's going to happen 6 months from now, a year from now. But when I'm just talking about the next few months, maybe this summer, it is looking unlikely that inventory is going to rebound in any significant way. Now, one interesting dynamic here is that the median days on market has really shot up over the last couple of weeks. So, normally we were seeing 60, 65. Then when we were in the pandemic, it dropped down to, 45 days, but it's gone back up to the average. So one thing to watch here, if I were investing in Miami, is if this number keeps going up. If days on market continues to go on this trajectory, that to me is a lead indicator that may reverse some of the things I just said, that maybe that prices are going to decline. But right now, we just don't know. They're back up to about pre-pandemic levels, which we should expect in this type of market. Whether they go higher than pre-pandemic levels is going to be a really important thing to watch. But even given this, I think this is a really interesting dynamic, and this is happening in a lot of markets, is that days on market are going up, but inventory is not, which is weird. Normally, you would expect those things to happen at the same time. To me, my best guess of what's going on there is that there's some properties that are priced well and are going quickly, but there are a lot of sellers who are still trying to get exorbitant prices like they were back in June of 2022, and those are staying on the market longer, and that's bringing that median days on market up. But overall, the market is still clearing a lot of inventory regularly. That hypothesis that I have is sort of supported by this last chart that I'm going to show you here before we move on to rent data, which is the percentage of homes pending within 2 weeks. So basically, how long, what percentage of homes that go on the market go under contract within 2 weeks. And as you can see, it's shot back up. So it fell a lot over the last couple months as interest rates have risen. But you can see that just over the last couple months, it's going back up. So some houses are moving really quickly. And that's sort of how I came up with that hypothesis that some markets, some houses are priced well, priced to move, and are doing that. Other ones, you have sellers who are trying to, raise prices more aggressively, and sellers don't have as much negotiating power as they once did, as shown by the median days on market. And so maybe that's why we're seeing days on market go up while inventory is staying down. So that's what's going on with home sales in general. Again, just to summarize, basically home prices are staying relatively flat. And a lot of the lead indicators suggest that unlike Austin or some of these other markets on the West Coast that are seeing declines in prices, Miami has a good chance of remaining relatively flat. We might even see it grow over the next couple months. Of course, it could come down a little bit, but I think Miami, generally speaking, the way the data reads right now, is not at risk of any sort of crash or big decline in prices. It could be small declines in prices, but not any big sort of crash based on this data. Let's now turn to rent data, and I want to show you this first chart because it's pretty crazy here. You could see that from 2018 to 2021, rent prices in Miami were relatively stable at around $2,000 for the median asking price. Now they are above $3,000. So they've gone up 50%, which is staggering over the course of 2 years. So that is obviously placing a rent burden on the city. And we'll see in the next coming charts what that means for rent prices and vacancy. Now, this data right here that I'm showing you here comes from BiggerPockets. We have a proprietary database that we maintain with rent. So that's how we're looking at it. And this is residential data. So this is for anything that's for 4 units or less. From here down, we're looking at commercial data, and this comes from CoStar. This is data that we license here at BiggerPockets. Unfortunately, it's not publicly available, and it's pretty expensive, but I could show you what we got here. So basically what you can see in Miami is that the vacancy rate bottomed out in the beginning of 2022 and has now risen up to about 5.5%. That is still relatively low for multifamily standards. Remember, this is commercial properties here, so these are 4+ units. What we're looking at here is vacancies at about 5.5%. But if you look at CoStar, which does really good forecasting in this regard, they think that vacancy in Miami is going to peak up at about 9.5 or 10%. And that is because the underlying dynamics on this chart. We have net deliveries here, which is blue. That's basically how many new multifamily units are coming online. And orange, which is basically how much demand there is for those units. And as you can see, starting in 2022 and then extending basically through 2023, through 2024, and maybe even into 2025, we're seeing that net deliveries are outpacing absorption. That means there's more supply than there is demand. And that is a very logical reason for why vacancy would go up. There's just too many units for the amount of people who are coming in. We talked at the beginning of this episode about how many people are moving there, and that is still true. But there's just so much construction in the pipeline that is still outpacing the number of people moving there. And frankly, a lot of the immigration trends that we've seen through the pandemic are slowing down. That doesn't mean people are moving out of Miami. It just means fewer people are moving there every single year. And so that combined with the increase of construction means that there could be some vacancy. So if you look here at this next chart, which is sort of a breakdown of the vacancy rates, you could see that they're projecting on CoStar, the real thing that's going to be hit is these 4- and 5-star properties. That's luxury properties in Miami. So that means to me that there's an oversupply of luxury apartments in Miami, and they're going to face a lot of competition. And you can see here, look at this. This is vacancy going up about 15% here. Whereas, some of the 3 stars, sort of this, B or C class properties are actually projected in Miami to be lower than the United States average, which is the yellow line. So you can see here, there is sort of this breakdown of what is happening in the rental market, where luxury properties are projected to have really high vacancies, where 3-star, which is sort of like a B or C class property, is expected to do relatively well and have a lower vacancy rate than the US as a whole. So that's super interesting. What does this all actually mean for rent prices? What you can see here is these orange bars show the year-over-year growth. And you can see that, during the pandemic, just like everything, it went crazy. We were seeing double-digit price year-over-year growth. But CoStar expects that to come down to about 2% and even below that. And that is really significant for a few reasons. One, rent usually 2, 3, maybe 4% in big markets, but 2% right now is well below the pace of inflation. So CoStar is expecting in real dollars, so inflation adjusted dollars, for rent to be going down, at least for now. Like hopefully, knock on wood, maybe inflation will go down to 2%, but I think we still have a couple more months or maybe years for that. And so they are expecting, although inflation will probably come down, most people expect to the 4% this year. It's not coming down to 2% this year. And so rent prices are going to come down, or rent income in real terms, inflation adjusted terms, are going to come down. So that's really important to know. And I think is a really important factor for real estate investors to consider. So that's all the data I have for you guys today. Hopefully this is really helpful to you. In summary, I would say that Miami just shows incredible strength as a long-term bet in terms of population. People are moving there. Businesses are moving there. But one thing I do want to call out that we don't have data here for is the cost of insurance in Florida. I read something just yesterday that premiums are going up 14% this year in Florida in general, and I'm sure Miami is no different from that. So that could really damage your cash flow, and it's something you should really pay a lot of attention to. Normally when I'm underwriting deals in Colorado or elsewhere, insurance, I'm not really that worried about it, but in Florida, insurance really has gone up over the last couple of years, so pay extra attention there. Strong fundamentals in the housing market. I don't really think that there's at risk of a big decline in Miami the way the data reads now. Of course, when I'm doing this data analysis, I don't have a crystal ball. I'm looking at what data exists now and trying to interpret it for the next couple of months. And from what I'm seeing, I don't see a big crash. I think Miami relative to other big cities is actually doing quite well. The exception there is rent, where we do think that vacancy is going to go up, and rent prices are going to lose pace to inflation over the next couple of years. So those are very serious considerations that you need to think about as an investor. But again, the lower tier properties, B and C class, seem to be less affected by the oversupply, are less likely to have an increase in vacancy. And so that might be an area for you to look. Hopefully this was helpful to you guys. That's all I got for you today. Again, if you like this kind of videos, we do really appreciate a thumbs up and to subscribe to this channel. If there are other markets that you want me to analyze, put that in the comments below. If you have any questions or thoughts, you can always hit me up on Instagram where I'm at The Data Deli. Thank you all so much for watching. I'll see you next time.